Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending February 17, 2023. Looking at the market indexes for the week, the TSX, S&P 500, and Dow Jones were all down on interest rate and recession worries, along with some poor earnings reports. The Russell 2000 and Nasdaq were up for the week a little bit. Gold and oil were both down a second week in a row. Turning to Canada, as prices surge for just about everything, Canadians are growing more worried about the economic climate and taking action to protect their wallets, a new LinkedIn data shows. Some 86% of Canadians said they are concerned about inflation and higher prices, according to the most recent Workforce Confidence Index, a quantitative online survey of LinkedIn members in Canada conducted between September and December of last year. It's not without good reason. Canada's Consumer Price Index was up 6.3% year over year at the end of 2022, following a 6.8% increase in November. In June, it had hit a four-decade high of 8.1%, with price increases significantly outpacing wage gains. Across generations, a majority of Canadians, 67%, said they were cutting down on spending in preparation for a potential economic downturn. For just under half, 46%, this meant delaying a big purchase, while 43% said they were focused on paying off debt, and about 1 in 5 said they were working longer hours, 20%, or taking on a second job, 18%. Among millennials, nearly 1 in 4 said they were looking for a more stable job, 23%, compared to 12% of Gen X and 8% of boomers, while 17% were cutting back on retirement contributions compared with 11% across generations. The debate about a hard landing in the economy or a soft landing or a no landing continues. A hard landing is when the inflation possibly stays high or stays around longer via the quote sticky inflation, and there is a significant recession. Soft landing is when there is a lower inflation and an insignificant or soft recession, possibly still a strong employment market. No landing means the economy doesn't even get into a recession and inflation still eases. The soft landing is looking like a possibility, and no landing would be ideal. I personally think we'll have a soft landing with a mild recession, but some of the inflation will be sticky and interest rates will stay high. And turning to Canadian real estate, a new CREA, which stands for Canadian Real Estate Association report, says that home sales in Canada were at a 14-year low in January. Home sales in January were the lowest for the month since 2009 and down 37.1% compared with a year ago. The sales fell 3% month over month in January, and the home price index itself is down 12.6% year over year in Canada. Toronto is down 14.4%, and Vancouver is down 6.6% in yearly changes. Turning to the US, on Tuesday, the US CPI Consumer Price Index came out for January. The core and headline year over year inflation was higher than expected, but lower than the previous month, which the market took neutrally, being down marginally for the day. The month over month core CPI was especially important to traders who saw it as an okay enough score to be bullish or at least not bearish. So, looking at the actual results, the core CPI month over month came in as forecast at 0.4% and exactly the same as the previous month. The core CPI, which excludes the volatile energy and food, year over year was up 5.6%, which was higher than forecast, but down from the previous month's read. Looking at the headline inflation, which includes the volatile energy and food, The month-over-month CPI was, as expected, a 0.5%, but that was higher than the previous months. And the year-over-year for the headline inflation came in at 6.4%, higher than forecast, but down slightly from the 6.5% of the previous months. The real earnings, which is something that worries central banks as far as wage inflation, was up for the month over month at 0.7%. Turning to US bonds, the US bond yield curve is inverted once again and has been for a while. The US government 2-year is yielding significantly more than the 5, 10, or 30-year. The inversion precedes a large majority of recessions, but not every inversion causes a recession. The yield is higher on the 2-year bond because investors are expecting more risk in the short term to the US economy than later on. The higher risk in the short term requires more compensation or yield. Related to bond yields, they have become a great alternative to stocks, and the high yields have removed TINA, which is there is no alternative, from stocks, where people needed to buy stocks to get any yield, specifically from dividends. Now they have bonds as an alternative to dividend paying stocks. In the US earnings for Q4 that have been going on, 70% of the companies reporting are beating estimates, but there is a 5% decline in the estimates from 2022. So beats are happening, but against lower estimations. In a rare moment of accord between the Biden administration and Elon Musk's electric vehicle empire, Tesla agreed to open up thousands of its charging stations to EVs made by other companies, according to the White House. Tesla and other companies that build and operate charging networks are also in line to win federal funding if their charging infrastructure lives up to government standards. Tesla agreed to make at least 7,500 chargers in the US available to any compatible EV by the end of the year. That includes 3,500 of the company's superchargers that are located on major highways, in addition to slower level 2 destination chargers that Tesla provides at restaurants and hotels, among other locations. It's not all good news in the world of EV batteries, though. Ford halted production and shipments of its flag F-150 Lightning pickup over a possible issue with its batteries. The company did not disclose too many details about the potential problem, which came to light during pre-delivery quality inspections. It's the latest difficulty facing Ford. Earlier this month, the company posted ugly fourth-year quarter results and a net loss for 2022 as it copped to execution problems. Ford is looking to cut costs this year as it seeks a turnaround with EV competition heating up. The US tech companies have been very public with their layoff announcements. It could be argued that they overhired during COVID, expecting technology to help us stay in our homes and do and get everything remotely. With the vaccine, it's back to a normal world and they are laying people off, both because of the overhiring and because of the expected recession. However, looking at the chart, they are laying off a very small percentage of the people they hired since the end of 2019, never mind their total workforce. The US unemployment rate is extremely low, and the well publicized layoffs, mostly for the benefit of investors, are a drop in the bucket. Now for some bits and pieces. Of the major world economies, China is the only economy that is growing and expected to grow. The other economies are slowing and recessions are already happening or a good possibility. China is emerging from its COVID lockdowns and has been cutting interest rates to stimulate its economy. It may be an opportunity for investment. The price of shipping goods on vital global trade routes has fallen 85% below its peak as the supply chain issues resolve themselves and seems to indicate inflation slowing. Shipping costs and supply chain issues were only one aspect of the increased inflation in 2022, however. And finally, after nearly a decade of outperformance, US equities trailed the rest of the world in 2022, and many wonder if this shift in performance will continue in 2023. In my view, improved economic outlooks in China and Europe, coupled with a weaker US dollar, may favor international markets in the near term. And finally, looking at next week, we have companies reporting for Q4. On Monday is BHP. On Tuesday is Walmart, Home Depot, HSBC, Palo Alto, and Tech Resources. On Wednesday is Nvidia, Baidu, eBay, CCL Industries, and Bausch & Lomb, and Whitecap Resources. On Thursday is Alibaba, Moderna, Canadian Pembina Pipelines, Emera, Northland Power. And on Friday, we have CIBC, Dell, and CI Financial. Economic events next week. On Tuesday, we have the Canadian Consumer Price Index. On Wednesday, we have Canadian New House Price Index. Thursday is US jobless claims. And on Friday, we have US PCE, which stands for Personal Consumption Deflator, which is something that the US Fed likes to use for its inflation ratings. That concludes my thoughts for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.